Okay, so in this video, I'm going to show you why mortgages, residential mortgages, yes, like you go to the bank, get a mortgage, are probably the best investment vehicle that you have never thought about owning. So a lot of people, they buy stocks, they buy bonds, mutual funds, rental properties, but at the end of the day, the bank wins. We all know it, but we never ask how can we actually become the bank. And so in this video, I'm going to show you a deal that we recently did and how you can become the bank with a little bit of money. So the first things first we have to get into are the property details. And you're like, well, we're not going to own any property. We're the lender. We lent this money to someone who was going to rehab the property. So you don't have to have a ton of money. I know you're thinking of home loans, $300,000, $400,000. We did this with $35,000. Okay. And so you're over here and you're like, well, this says 148,000, and you're right, it does. This is the property details. So it's a nice house. It's in Ohio. It's 3-bed, 2-bath, 1,500 square feet, and its Zestimate is $148,000. Now, you can agree or disagree with the Zestimate. Call it 130 if you're worried about it. Let's say 145, and we lent them $35,000. Now, we lent this money to them. If you know anything about mortgages, you know there's first position, second position, third position, sometimes fourth or fifth. Typically, it's just first and second. And so all that means is if they stop paying and you have to foreclose, first position gets paid first, second position gets paid second, third position gets paid. Great, good guess. Third. The only thing that can go in front of a first position lien are like government liens, taxes and stuff like that. There's a few other things, but overall, unless they have a $100,000 lien that's above a first position lien, we're going to get paid, right? And so our money is safe, right? So we really have 4 boxes. This is not 4, this is 4. When we evaluate an investment, right? So we want cash flow. What else do we want? We want a good return. Okay. Put a little line there, put a line there. What else do we want? Consistency. Okay. And then we want risk to be low. Awesome. So we're going to cover each one of these box by box, and that's going to be the video. Now, we lent them $35,000. We haven't gone into detail. We lent them $35,000 at 10%. And so all that means, this was an interest-only loan. There's 2 types of loans. There's interest-only, amortized. This was an interest-only loan. Your longer loans, like home loans, stuff like that, or primary residence loans, stuff like that, are going to be amortized, where you pay back the principal and interest. But this was interest-only, so we're going to abbreviate that as IO, interest-only. And so all that means is we give you $35,000 today. Oops. We give you, I did it twice. $35,000, right? They're going to pay us. It's $3,500 a year is the 10%. It's like $293 a month or something. So they're going to pay us $293, $293, $293, $293, and then we're going to get back our $35,000. So instead of them paying this balance down over time, right? We're going to keep the balance the same, and then at the very end, they pay it all back in one lump sum. Whether they refinance into long-term financing that's at a lower rate, so instead of paying 10%, they could pay 6%, or they sell the property and flip it. They have $148,000. $35,000 of that goes to paying us off. So they pay us $3,500 a year. So cash flow wise, that's awesome, right? So we could check this box. And that's only with $35,000. Like, we're getting $3,500 a year off of $35,000. Now, yeah, you're like, I need $1 million to retire. Correct, but you only need you only need $1 million to retire. Return-wise, could we say that a 10% return is good? And I know what you're thinking. Well, what if they stop paying? Great question. Well, if they stop paying, we get the $148,000 house. So our best case is that they stop paying, and our worst case is actually that they pay us, because we get a 10% return if they pay. If they don't pay, we quadruple our money. So return-wise, we're doing great. 10% beats the stock market, keeps it right up with it. But this is where we differentiate ourselves, right? And it's in the consistency aspect of it. So $35,000, we would go $35,000, 38.5. I don't know what it would be after that. And this can compound. Depends on how it's structured. Typically, it can compound. Whereas the stock market might go up 8%, down 6%, up 12%, and it's not something you can consistently rely upon. Because if you are investing, ideally you want consistency, and you want it to consistently go up. People who buy bonds like them because of consistency. And so we get paid every single month, and if we don't, we quadruple our money in this case. So we'll go ahead and mark consistency as good because it is good. It's a very consistent investment. Think about it. How many times have you missed a mortgage payment? Especially when you have $100,000 worth of equity. And on top of that, just as a side note, the 90-day delinquency rate, which means how many days are 90 or more days late on their mortgages, is right around 1.8% at the making of this video. So 98% success rate, pretty safe if you ask me. Now, or pretty consistent if you ask me. Now, our last box we have to cover is risk. How much risk are we taking on when we do this? Me personally, I would do this deal before I did anything else. Like if I was purely for risk, I would literally do this before I loaned money to the US government. Like before I bought a treasury, I would fund this deal. And the reason why, once again, is because we deployed $35,000 and we make 10% a year, $3,500. And if they stop paying, their collateral that they put up is a $150,000 asset, right? And so you literally have two scenarios after year one, right? What are your two scenarios? Well, scenario number one is that your $35,000 turns into $38,500. Now, the reason that it went from 35 to 38 is the 10% on this is 3,500. So 35,000 plus the 3,500 equals 38.5. Pretty simple math. And then our second scenario is we turn 35,000 into $148,000 property. And so these are our two, like legitimately the only two options that we have. The third one is quite extreme, and that would be that property values fall by 85%. We have to foreclose on them, and our $35,000 actually loses because this property goes from being worth $150,000 to being worth less than $35,000, which never in the history of the world have real estate prices in the United States of America dropped by 80% plus overnight. So these are our two scenarios. Overall, I would say it's pretty not risk-free. It's very risk-appropriate. Or I don't know if that's the right term. And so we cover all four of these boxes, right? We have good cash flow. We're getting $3,500 a year, 10%. Okay. We have a good return. We're just getting the same 10%. But this happens every single month. And once like these carry over, like these all impact each other. And so consistency-wise, right? We get paid. Our cash flow hits every single month. And so check, perfect. And risk-wise, our $35,000 either turns into $38,500 or it turns into $148,000. And so if you ask me, it's a pretty good business to be in. And it really doesn't take a lot of money. We've done one of these deals before with as little as like $6,000. So you don't have to have a ton of money. But with that being said, if you are interested in learning more about this or buying a note yourself, a mortgage yourself, down below in the description, we have links to a free course that I put together. It's an hour, probably 2 hours long. And then you can join our note buyers list where we go and find these deals for you and send them directly to you so that you don't have to do the hard work, right? It's pretty cool if you ask me. So with that being said, that's all I have for you today. I hope you enjoyed. More importantly, I hope you learned something. So see ya.